everyone. I think that's my cue to go ahead and get things started. So again, good morning. I'm Austin Sagas. I am the operations manager for SC Launch at the South Carolina Research Authority. I want to make sure that I tell the audience ahead of time, we're going to be covering a lot of content in the next 45 minutes to an hour. And I want to encourage everyone to, if you have a question throughout this presentation, go ahead and just make a note on a sticky pad or on a notepad, because we might answer it later on, either on the next slide or maybe later in the presentation. And then as we get closer to the end and we start opening the floor for questions, that'll give you the opportunity to either cross out that question you might have had, or you can submit it in the chat. Just want to give you guys that announcement. I'm going to go ahead and introduce our speakers today. We have two wonderful resource partners here from Nelson Mullins. We have Mason Hogue and Maurice Holloway. That, like I said, they are both partners with Nelson Mullins, Riley and Scarborough, and they're also an official South Carolina Research Authority resource partner. And it's been a lovely relationship, being able to work with them, seeing the value that they add to our clients and to our companies is absolutely wonderful. And I want to go ahead and just say thank you guys so much for all of your contributions to our member companies and to the state in general. Just providing some high-level introductions here. Maurice, he advises clients on the tax aspects of things related to mergers and acquisitions, company reorganizations, restructuring of business entities, and private equity transactions. Whereas Mason's area of focus is representing growth companies with respect to corporate, venture capital, also mergers and acquisitions, any strategic alliances, and as well as technology and licensing matters. So these are the folks we got with us today. Mason, I'm going to turn the floor over to you to sort of open up this dialogue.
Thank you, Austin. Can you hear me?
Yes, we can.
Great. Appreciate being here today. Nice to have the opportunity to speak to everyone. Maurice and I, we're a part of our firm's venture capital practice, and we do routinely work with startup and growth companies as general counsel, as Austin mentioned. One of the issues that we frequently deal with is advising on the choice of entity and qualified small business stock. The purpose of our presentation today is to review the benefits of qualified small business stock and what is required to qualify as qualified small business stock. The benefits of qualified small business stock, they are significant. At a high level, the taxpayer who sells qualified small business stock potentially will not have to pay federal and in some cases state income tax on any gain up to $10 million or 10 times the taxpayer's basis in that stock, if greater. This benefit is virtually unmatched throughout the federal income tax code. Unfortunately, one problem we have found is that founders do not realize that these benefits exist until it is too late to take the appropriate steps to qualify. For example, as a general rule, at the time the stock is issued, the company must be a C corporation to qualify. There's some ability to later restructure some entities into a C corp in a manner for founders to qualify, but with limitations. It is not possible to qualify and receive any real benefits near or immediately prior to the sale of a company. There are also other events that disqualify a company's owners from receiving the benefit. One example is stock buybacks of certain types, stock redemptions, or certain amounts. My tax colleague, Maurice Holloway, routinely deals with these issues, and he will provide an overview today of the benefits and qualification requirements of small business stock. Maurice?
All right, thank you, Mason. Can everybody hear me?
We sure can.
Okay, all right, thank you. Good morning, everybody. Thanks for joining us today. And as Austin mentioned earlier, we do have a good bit of material to cover today. So I am going to get right into it so that we can leave some time at the end of the presentation to address any questions that may come up during the course of the program. Let me get started by seeing if I can get my screen shared here. Okay. Hopefully everybody can see my screen.
We sure can. Looks
right.
great.
Thank you, Austin. So I'm going to go ahead and get us up to the general overview here. Just several bullet points of the sorts of topics that we want to cover today. I'm not going to go down the list right now. We will address them as we get to them in the program. And want to start off with the Mason mentioned that, you know, lots of times when we're starting off, when we're counseling startup companies, the very first decision that, you know, has to be made is how do you want to set up the company? And particularly, how do you want the company classified for income tax purposes? And for tax classification, basically 4 types of tax classifications that apply to business entities under the U.S. tax code. The business entity can be a C corporation, it can be an S corporation, be taxed as a partnership, or taxed as a disregarded entity. And, you know, oftentimes, you know, we have clients that set up LLCs and they'll think that, well, you know, my LLC is going to be subject to LLC taxation. Well, not necessarily, because there's no such a thing as LLC taxation. If you have an LLC, for example, it's going to have to fit into one of these 4 categories, generally speaking. It's going to have to be classified as a C corporation, an S corporation, a partnership, or a disregarded entity. And as Mason already mentioned, for purposes of qualifying for the benefits for qualified small business stock under Section 1202, the company issuing the stock has to be a C corporation. So when we weigh the pros and cons of the various alternatives for tax classification, clearly one of the pros, one of the benefits of structuring your entity as a C corporation is the ability to take advantage of this qualified small business stock exclusion under Section 1202. And since the enactment of the Tax Cut and Jobs Act, effective January 2018, which lowered the C corporation tax rate to a flat rate of 21%. And when you add that along with the benefits under Section 1202, it is a lot easier to reach the decision these days that, yes, we want to set up the startup venture as a C corporation for tax purposes. So what is the benefit under Section 1202? And we'll start off, if you look at this table, it's probably a little bit more complicated than it needs to be for this presentation, but I'm going to try to simplify it and just focus on certain key aspects of this table. In that first column, notice that we have date of stock acquisition, and we have several time frames listed there. If the stock was purchased or acquired before August 10th, 1993, it's not going to qualify for the special benefit under Section 1202. If the stock was acquired between August 11th, 93 and February 16th, 2009, then the benefit under Section 1202 is going to be an exclusion of 50%. If the stock was acquired between February 17th, 2009 through September 26, 2010, the exclusion percentage is 75%. And if the stock was acquired on or after September 27th, 2010, the exclusion is 100%. And for purposes of this presentation today, that's the exclusion that we're going to be focusing on, is the 100% exclusion. If you go to the far right column and on that bottom row involving the 100% exclusion, you can see there's a 23.8% rate. Generally, when a taxpayer sells stock in a C corporation, that taxpayer, an individual taxpayer in particular, is going to be subject to a 20% long-term capital gain rate to the extent that there are any gains in the sale of that stock, and that individual has held that stock for greater than a year. And also there's going to be a 3.8% net investment income tax that's also going to be applicable. So that's where we come up with the 23.8% in that last column, last row. So in effect, by virtue of qualifying for the 100% exclusion under section 1202, then the taxpayers in essence is going to be saving 23.8% of federal tax on any gain generated from the sale of that qualified small business stock. And I say any gain, as we'll see here on this next slide, there are some limitations on the amount that can be excluded. So let's look at those rules, and of course, the amount of gain would be subject to these limitation rules. And these limitation rules apply on a individual by individual, or taxpayer by taxpayer, or shareholder by shareholder basis. And they also apply on a corporate by corporate basis. So for example, if I invest $1 million in ABC Inc., and then I invest $1 million in XYZ Inc., then this limitation rule that we're going to focus on, I get the benefit of that limitation rule with respect to both corporations. And with respect to a single corporation, you apply these rules on a shareholder by shareholder basis. So again, let's look at the limitation rules. There's basically two limitations here. One we refer to as the cumulative limitation, and one we refer to as the annual limitation. And the taxpayer gets to exclude gain under 1202 to the extent of the greater of these two limitations. The cumulative limitation basically is a $10 million aggregate limitation over the life of the investment. So anytime a taxpayer sells stock that qualifies as for the benefit under 1202, the taxpayer has to look and see if he or she has disposed of that stock, any of that stock previously, stock in that particular corporation previously that qualified for this benefit. And to the extent that there have been prior transactions where the taxpayer has taken advantage of this exclusion with respect to stock in this particular corporation, then you have to reduce this $10 million number by the earlier exclusions, and that's going to be your cumulative limitation. The annual limitation, you have to look at the taxpayer's basis in the stock. The taxpayer gets to exclude up to 10 times the aggregate adjusted basis of the stock being sold in that particular corporation. So, for example, if the taxpayer invested $1 million, let's say the taxpayer invested $2 million in the company, and then there's a sale of the company, and the sale qualifies, the stock qualifies as qualified small business stock, then in that instance, the taxpayer's limitations is going on the amount of gain that can be excluded is 20 million, 10 times his $2 million basis in the stock. And with respect to husband and wives, again, these limitation rules apply separately. So if you have a husband that invests in a corporation and a wife or spouse invests in that same corporation, then they both have these limitations apply to them separately. So in the case of the $10 million limitation, for example, each will have his or her own $10 million to work with. All right, let's look at an example to try to see how these rules work. In year one, which is sometime after 2010 in this hypothetical, an individual invests $4 million in ABC Inc., a C corporation, in exchange for 100 shares of ABC common stock. In year 6, A sells 50% of his ABC shares for $20 million. If A's ABC shares do not qualify as qualified small business stock, A would have to recognize gain of 18 million, and that is the $20 million sales price less the $2 million basis that A has in 50% of his stock. Remember, he paid $4 million for 100% of it when he made his original investment. A will have to recognize gain in this scenario of $18 million. And based on current federal tax rates, would have to pay taxes of $4.284 million. That's basically his $18 million gain multiplied by the 23.8% tax rate that we just looked at on the previous slide. If A's ABC shares qualifies small business stock, then A will get to exclude gain up to an amount equal to the greater of $10 million. Because in this particular example, A hasn't utilized the 1202 exclusion for any earlier transactions with respect to this corporation stock, or 10 times his basis in the stock sold. In this case, he sold 50% of his stock. His basis in that stock was $2 million. 10 times $2 million is 20 million. So we can see between the two limitations, the cumulative limitation and the annual limitation is going to allow A to exclude more gain. A's gain in this case is $18 million. Since that is inside or less than his limitation amount of 20, A is going to be able to exclude all $18 million of the gain via section 1202 of the Internal Revenue Code, and would therefore owe no taxes on the 4.2, will owe no taxes on the $18 million gain that he's just received by virtue of this transaction, basically saving the $4.284 million. And I make one quick point here on the tax benefit. You know, this example, and our focus up to this point has been on the federal tax savings that section 1202 provides. You also do have to remember state income taxes when actually engaging in a transaction, because some states do not follow section 1202. California and Pennsylvania being two of those states. South Carolina does. So if you, in A's example, if A is in this example involving A, if A is a resident of South Carolina, A also would not pay any South Carolina income tax on the $18 million gain he recognized in that example. But you do always have to remember the state income tax consequence. Okay, who is eligible for this benefit? Only non-corporate shareholders are eligible for this exclusion, and that includes, you know, individuals, trusts and estates, and in some instances, partnerships and S corporations can own qualified small business stock and take advantage of this exclusion. Partnerships and S corporations are what we refer to as pass-through entities. Generally speaking, any gains and income that partnerships and S corporations recognize for tax purposes, those income amounts and gains get passed through to the owners of the partnerships and the S corporation. And again, and we'll talk about this on a later slide in more detail, but if that partnership and S corporation owns qualified small business stock, then it is possible that one or more of the owners of the partnership and S corporation might be able to benefit from the exclusion to the extent of their share of that gain. Having an ineligible shareholder does not prohibit or eliminate the ability of other shareholders who might otherwise qualify from taking advantage of the exclusion. So if you have a company that has several individual investors, but also has a significant or at any level C corporation investor, the fact that the C corporation can't take advantage of this exclusion doesn't prohibit or prevent the individual investors from being able to do so. And the exclusion only applies to stock sales. It does not apply to an asset sale. So to the extent that the liquidity event of the corporation is in the form of a asset sale, then any gain that the corporation recognizes from the asset sale will be taxed to the corporation. The corporation will have to pay tax on that gain, irrespective of the fact that the corporation may be a qualified small business as defined under 1202, and it may have shareholders who own qualified small business stock. Now, if there is a liquidation shortly after the sale of the assets, such that, you know, normally when you have a liquidation of a corporation, that liquidation event is a taxable event to the shareholders. If any of the shareholders own stock that qualifies as qualified small business stock, then presumably those shareholders would be able to take advantage of this exclusion as it relates to any gain generated from the liquidation at the shareholder level. And also, this is the biggie requirement, that in order to be able to take advantage of this benefit and for the stock to qualify for the exclusion, the taxpayer selling the stock will have to have held the stock for at least 5 years from its original date of issuance. All right, what is a qualified small business? Must be a domestic C corporation. We've talked about that a couple of times already. At all times after 1993 and before issuance of the stock, the aggregate gross assets of the corporation must not exceed $50 million. And also, immediately after the issuance of the stock, the gross assets cannot exceed $50 million. Now, for purposes of applying this gross asset test, we actually get to look at not the value of the asset, but the corporation's basis in the asset, generally speaking. So, and why this is a big deal is it basically eliminates, it allows you not to take into account any intangible value for purposes of applying this $50 million threshold. So if you have a startup company and it's been around for several years and it has grown in value substantially, but a lot of that value is represented in, say, in the form of goodwill, intangible value, then that intangible value won't be taken into account for purposes of applying this $50 million threshold. So conceivably, you can have a company that's worth $60 million, and it can issue stock that it can still qualify as a qualified small business, as long as the adjusted basis and its underlying assets don't exceed the $50 million threshold, although the corporation clearly is worth more than $50 million. And the one exception to being able to utilize the basis for purposes of applying this test is when you have assets that are contributed to the corporation. So if you have a corporation that has received a contribution of assets for purposes of applying this rule, this basis rule, then those assets, or the corporation is deemed to have a basis in those assets equal to the fair market value of those assets. So irrespective of what the corporation's tax basis may be under the normal tax basis rules, if the assets have been contributed to the corporation, then for purposes of this particular rule, the corporation's tax basis is going to be deemed to be equal to fair market value. Okay, what is qualified small business stock? The stock, as we again identified earlier, has to be issued after August 10th, 1993. The stock has to be issued by a qualified small business. The shareholder must have received the stock directly from the corporation. So if you got a shareholder that owns stock in ABC Inc. that it purchased from another shareholder, that will not qualify as qualified small business stock. The stock must have been acquired in exchange for cash, property other than stock, or services other than underwriting services. And during substantially all the shareholders' holding period for such stock, the corporation uses at least 80% of its assets measured by value in the active conduct of one or more qualified trades or businesses. And with respect to that substantially all requirement, there's no real clear specific guidance as to what substantially all means in this context, but it's kind of generally understood that something probably in the 75 to 85% range or higher of a holding period time frame probably gets you there. But again, there's no clear guidance on what actually constitutes substantially all if that becomes an issue in your particular case. All right. Special rules in applying the receipt and holding period rules. As we just mentioned on the previous slide, you have to receive the stock. The taxpayer has to receive the stock directly from the corporation. And we mentioned on the earlier slide that you have to have held the stock for greater than 5 years in order to be able to take advantage of the exclusion. Some exception and special rules. If stock is received by gift, inheritance, or distribution from a partnership, then in those instances, the stock can still be considered to be qualified small business stock. In applying these rules, for example, if there's a gift, then the donee, the recipient of the gift, will be treated as having acquired the stock in the same manner as the donor or the person making the gift. So if Dad is making a gift to son and Dad received the stock because Dad made an investment directly into the corporation and received the stock directly, then son will be deemed to have received the stock directly as well, and therefore potentially the stock can qualify as qualified small business stock in son's hands. The recipient will also get the tack on the previous owner's holding period. So to the extent that Dad has held the stock for 3 years at the time he makes the gift to son, then son is deemed to have owned the stock for 3 years as well. So now son only has to own the stock for an additional 2 years for purposes of satisfying the 5-year holding period. Another exception to the directly received from the corporation rule is that qualified small business stock converted into other stock of the same corporation will also potentially qualify for qualified small business stock treatment. In a conversion transaction, stock received in exchange for the original QSBS stock will be also treated as QSBS, and the holding period for the original QSBS stock will be tacked on for purposes of the converted stock in applying the 5-year rule. For example, you may have a shareholder that owns preferred stock with a conversion feature in the common stock. And if that preferred stock otherwise qualifies as qualified small business stock, when it's converted to common in the same corporation, the common can qualify as QSBS as well, and the shareholder gets to take into account the time frame in which it owned the preferred stock for purposes of determining if it's held the common stock for the requisite 5 years. Special rules in the compensation context. If you have an employee that is receiving, service provider receiving stock upon the exercise of an option, the issuance date of the stock will be at the time the option is exercised. So that's when the 5-year period starts running for the recipient of the stock. The time frame in which that individual owned the option would not assist or apply toward the 5-year holding period. If restricted stock is granted to a service provider, then the holding period commences or starts when the stock vests, or if the recipient makes a Section 83B election with respect to the stock, then the clock on the 5-year holding period starts at the time of the Section 83B election. What is a qualified trader business? And generally, it's any trade or business other than the types of businesses I have listed here on this slide. Not to dive too deep into this, but generally you can see in the first bullet point, most service-oriented business, particularly professional service-oriented businesses, won't qualify. Banking and financial and investment-related businesses won't qualify. Farming business, oil and gas businesses, hotel, restaurants, or similar type businesses generally will not qualify as qualified trader businesses for purposes of satisfying the active conduct of a qualified trader business. Just a couple of points here to make additional points to make on the qualifying as an active conduct of a qualified trader business. There's a working capital exception. So to the extent that assets are being held in the company for working capital needs, then those assets, won't jeopardize the company's satisfying the test that at least 80% of his assets have to be used in an active conduct of a qualified trader business. And even if those assets aren't currently being used for working capital needs, but they are being held, investment assets that are being held, and there's a reasonable expectation that they're going to be need for research or research and development or working capital needs in the next 2 years, then again, those assets won't jeopardize the company's ability to satisfy the 80% active conduct of a qualified trader business test. If the corporation has 10%, if 10% or more of the value of the corporation's assets constitute real property that is not used in the active conduct of a qualified trader business, then the corporation would automatically fail the active conduct test. And also, and I don't have it on this particular slide, but if the corporation owns stock in another corporation and doesn't own at least 50% of stock in that other corporation, then that stock, again, won't be attributable to the ownership of that stock won't be attributable to an active conduct of a trader business. And if that, in the aggregate, that stock is 10% or more of the total value of the assets of the corporation, that would also cause the corporation not to satisfy this active conduct test, and therefore not be treated, the stock held by the shareholders won't be qualified small business stock. And let me rephrase that, because again, this active conduct requirement says that it has to be satisfied for substantially all of the period in which the shareholder has owned the stock in the corporation. So conceivably, you could have a scenario where for the most of the life of the ownership of stock in a corporation by the shareholder, the corporation has satisfied the test, but maybe immediately, some short time frame immediately before the liquidity event, maybe the test is not satisfied. In that particular instance, I think that the taxpayer would still be in good shape. All right, common pitfalls that jeopardize qualified small business stock status. And the one that probably needs to be you need to be on the lookout for more than any are redemptions. If there are certain redemption transactions, if the corporation engages in certain redemption transactions, then those redemption transactions potentially can cause certain stock issued within certain relative timeframes to those redemption transactions as not qualifying for qualified small business stock. And for example, lots of times you have, closely held privately held companies, it's typical that you'll do a shareholders agreement, and there'll be certain triggering events under that shareholders agreement that allow the other owners or the corporation to buy out the owner with respect to which the triggering event occurred. For example, like death or divorce or disability. And if those transactions once triggered under the shareholders agreement or accomplished via a redemption by the corporation, that's the sort of transaction that has the potential of triggering these rules and jeopardizing stock that's being issued by the corporation from being qualified small business stock. And there are two separate redemption rules. One, this first rule that we addressed on this slide involves redemptions involving the taxpayer and related persons. And in this instance, if there's basically a 4-year window, if the redemption, once the stock is issued, then you look back 2 years and you look forward 2 years. So you could have stock that is issued on day one, and at that particular point in time, it could look like it qualifies for qualified small business stock because there's been no problematic redemptions in the preceding 2 years, the 2 years preceding the issuance of the stock. But you also have to make sure that there's no problematic redemption 2 years after the issuance of the stock, because if there is, then again, retroactively, the stock will not qualify as qualified small business stock. So if you have an investor, if you are an investor and you are investing in with the hope that one day there'll be a liquidity event and your stock will qualify as qualified small business stock. So one of the things you may want to negotiate with respect to your investment is a limitation or restriction on redemptions for a certain time frame to avoid these rules being applicable. Now, the rule just quickly here, again, there's a 4-year window, 2 years prior to issuance and 2 years subsequent to the issuance. And the rule says if the corporation is redeemed more than a de minimis amount of its stock from the taxpayer or from a related person, from a person related to the taxpayer, then this rule is triggered and the stock issued to the individual will not qualify as qualified small business stock. And again, the redemption here only applies to redemptions of stock owned by the taxpayer who's receiving the issuance of the new stock or a person related to that taxpayer. So if there's been a redemption, say, just inside the 2-year window prior to the issuance, but that redemption was of a shareholder who was not the taxpayer or a person related to the taxpayer, this particular rule would not be applicable. Quickly going to the next rule referred to as significant redemptions. The window here is a 2-year window. You look back 1 year prior to the issuance of the stock and you look forward 1 year subsequent to the issuance of the stock. And again, if the corporation redeems more than the de minimis amount of stock during that time frame with an aggregate value exceeding 5% of the aggregate value of all of its stock as of the beginning of the 2-year period, then this rule is triggered. Now here, the time frame is more limited, but the application is broader in the sense that when there's an issuance of stock and we're applying the significant redemption rule and we go back 1 year, any redemption is a potential problem under this rule, and not necessarily solely redemptions of the taxpayer or a related person. Other situations to watch out for, transfers to partnerships. We talked earlier about how the stock the general rule says that the taxpayer has to receive the stock directly from the corporation. And we talked about some exceptions on earlier slides. Well, another exception in the corporate context is if you receive stock that's qualified small business, otherwise qualifies as qualified small business stock, and then you exchange that stock for stock in another corporation, and the transaction by which you receive the stock, that exchange occurs, qualifies under the tax code section as a section 351 transaction or reorganization under section 368 of the tax code, then the stock being received in that transaction can also qualify as qualified small business stock. Or let me restate that. If the stock received in the 351 or the 368 transaction qualifies as qualified small business stock, then that's not a taxable event, and any gain, any appreciation, a built-in gain that existed in the stock, the original stock at the time of the transaction, when there's a subsequent or ultimate liquidation of the stock received in the transaction, all of that gain can potentially qualify for the exclusion. The gain that associated with the appreciation occurring prior to the transaction, and the gain associated with the appreciation occurring subsequent to the transaction. So that's a special rule for corporate stock. And let me also add this with respect to that rule. If the stock received in the 351 or 368 transaction isn't qualified small business stock, then you still get to take advantage. The law still allows you to take advantage of the exclusion of section 1202 as it related to any appreciation that existed in the stock, the original stock at the time of the transaction. So if I have a transaction where I give up stock, dispose of stock in the transaction that qualifies under 368, and my appreciation or built-in gain in that stock at that time was $1 million. And then subsequently down the road, there is a liquidity event where the stock I received in that 368 transaction, I get paid $3 million for it. Well, if the stock I received in the 368 transaction didn't qualify or doesn't qualify as qualified small business stock, then I don't get to rely on the 1202 exclusion with respect to that incremental $2 million of appreciation that occurred post-transaction. But for the $1 million that existed in the stock at the time of the transaction, I still get to take advantage of the 1202 exclusion. And just focusing on this second bullet point here, there's no similar rule for partnerships. So again, this is just something to be on if you own qualified small business stock, to be on the lookout for, because there's an analogous provision to the section 351 provision in the code that applies to corporation. There's an analogous provision that applies to partnerships called section 721, where there's no similar type rule or exception under the 1202 rules that applies to partnerships in 721. So, and this comes up often in M&A deals when you have a target company, some of the shareholders own, some or all of the shareholders own qualified small business stock, and there's a rollover component to the transaction, and the shareholders, some of or all of the shareholders are being asked to roll over a portion of their shares as part of in exchange for ownership interest in one of the acquisition companies. Then to the extent that the shares are being rolled over into a entity that is taxed as a partnership, and the partnership interest that that taxpayer receives in exchange for those QSBS shares will not qualify for QSBS treatment. So with respect to those rollover shares, you basically blown the opportunity of qualifying for the exclusion under 1202. QSBS held in the pass-through entity. As I mentioned earlier, generally speaking, the owner of the stock, in order for it to qualify for the exclusion, has to be an individual, trust, or estate. In some instances, if the owner is a partnership or an S corporation, it can also qualify for the owners of the partnership of S corporation. The pass-through entity can potentially qualify for the exclusion with respect to QSB stock that the partnership or the S corporation owns. And in this instance, let's say if you got an S corporation that owns stock in another corporation, and that stock otherwise is qualified small business stock, including the meeting the requirements of the 5-year holding period, then when that stock is sold, then the partner or the shareholder of that pass-through entity can exclude gain, the portion of the gain that gets allocated to that partner or shareholder, depending on whether you're dealing with a partnership or a S corporation. As long as that partner or shareholder owned his or her partnership interest or shareholder interest at the time the pass-through entity acquired the QSBS stock. So for example, if the S corporation invests in a C corporation and receives stock that ultimately qualifies as qualified small business stock, then you had to, in order to be able to take advantage of this benefit, the exclusion under these rules, the S corporation shareholder had to be a shareholder at the time the S corporation purchased or acquired the qualified small business stock. A person who became a shareholder after that would not be able to benefit from this rule. And that's actually the next bullet point is actually the one that I just spoke to. Okay, I actually jumped over one here. Just backing up here on the second bullet point. Sorry about that. The second bullet point just establishes the rule that in order to qualify, in order for an owner of an S corporation or a partnership to qualify for the special pass-through exclusion rule, they have to have owned the stock or the partnership interest for the entire period. So not only would they have to own their ownership interest in the pass-through entity at the time the pass-through entity acquires the qualified small business stock, but they would need to own that interest throughout in order to be able to exclude the gain. Throughout, meaning from the point in time the QSBS was acquired through the time the QSBS was disposed of. All right, situations. What if you have a business and it was originally formed as a partnership or an S corporation, but you now want to convert it to a C corporation because you want to take advantage of the ability to issue qualified small business stock, and you may have an investor coming in who's requiring, or as a condition to making the investment, that that the corporation be or that the business entity be converted, so that this investor can take advantage of the benefit under these rules. So we're going to look at two scenarios here. One where the company was originally formed as an S corporation, and second where the company was set up as a partnership originally. One thing that can be done in this particular instance, if you have an S corporation, is you can go ahead and convert the S corporation to a C corporation, and that's typically, that can be done one of several ways. One is you can just simply file an election, a revocation election with the IRS, revoking, alerting the IRS that you're revoking your S corporation status, which will automatically make the company a C corporation. And another is if the person the investor that's investing in the company is not a eligible S corporation shareholder, then the S corporation election is going to terminate it as well. But in this instance, if the goal here is to terminate the S election in an attempt to qualify stock issuances as qualified small business stock, I would recommend being more proactive and not necessarily relying on the automatic termination rule. One point here to note that the conversion of the S Corp to a C corporation will only help with respect to stock issue after the corporation has become a C corporation. So with respect to founder stock that was issued previously while the corporation was an S corporation, there's no way that stock is going to ever qualify under this scenario as qualified small business stock. Another option for consideration in this scenario where you've started off as an S corporation is have the S corporation contribute all of its assets to a new C corporation that would be owned by the S corporation, and the S corporation can then you can then set up this new C corporation that's the subsidiary of the S corporation now, so that the S corporation, the stock that the S corporation owns in a new C corporation qualifies as qualified small business stock, so that if there's an ultimate disposition of the qualified small business stock by the S corporation, then the owners of the S corporation can then hopefully take advantage of the rules that we spoke of earlier, being able to exclude gain realized by the S corporation when it ultimately sells to qualified small business stock. Now, I'm going to quickly, there's a special rule here that basically works. The mechanics of this rule work to accomplish an objective that the only gain that's going to qualify in this scenario for the exclusion is appreciation that occurs after the corporation contributes its the S corporation contributes its assets to a new C corporation. So if the company is worth $5 million when the S corporation contributes its assets to a new C corporation, and then and that stock that the S corporation receives from the new C corporation is qualified small business stock, then and that S corporation owns 100% of that stock, and that S corporation ultimately sells that stock for, say, $10 million, then only the incremental $5 million is going to qualify. The gain related to the incremental $5 million is the only portion of the gain that's going to qualify for the exclusion under section 1202. What if your company was originally formed and taxed as a partnership? And I think I made this point earlier, but just to make it clear, when we talk about a partnership, again, we're talking about an entity taxed as a partnership. So this would apply to an LLC taxed as a partnership, or any actual state law partnership as well. One option that you have here that you don't have with respect to the S corporation is you can convert the partnership here to a C corporation, and there's different mechanical steps that one can take to get you to that end result, that you have a C corporation. But unlike the S corporation scenario, the owner's historical ownership in the partnership, which is now being converted to ownership in the C corporation, can qualify for qualified small business stock treatment. But like the previous slide, only the gain appreciation occurring post-conversion is going to potentially qualify for the exclusion under these rules. And again, like the S corporation, the partnership could elect to contribute its assets to a new C corporation and then own stock in a new C corporation that could potentially qualify as small business stock. And lastly, I'll mention here is be aware of the $50 million gross asset threshold requirement when doing a conversion of a partnership to a C corporation or S corporation or a partnership contributing its assets to a new C corporation. Because again, general rule is when you apply the 50%, the $50 million gross asset threshold requirement, you look at the assets, the corporation's basis in its assets, tax basis in its assets. But the exception to that, if there's a contribution of assets, then you look at the fair market value of the assets. So if this conversion or this transfer to a new C corporation occurs later enough in the stage in the company's life cycle, you could potentially run afoul of that $50 million gross asset threshold requirement. So that covers what we wanted to talk about this morning. Again, I know I went through those slides fairly quickly, but wanted to make sure we got all the information in. So Austin, I don't know if we had any questions come in the chat, and I'm not sure exactly how much more time we have for questions, but let's do what we can.
Wonderful. Yeah, so there was one question from Rosalind, and feel free to maybe expand upon that, Rosalind. But she basically asked who are these stocks typically sold to? I didn't know if that was too generic. This might have been something we were talking about a little earlier.
Well, I can quickly chime in. Yeah, typically, from my experience, when we're talking about qualified small business stock and taking advantage of the exclusion that the tax law provides, it's usually in a typical M&A deal. I mean, you have your startup company, and the idea is to grow the company over some period of time, and eventually there's going to be a financial buyer or a strategical buyer that's going to come along and want to buy the company, what we would typically refer to as a liquidity event. And so that's usually when this issue now is first and foremost at everybody's mind, out of the owners of the target company, who owns stock that potentially qualifies for this benefit and who may not.
Gotcha. And then we have a second question from Tony, and he's noting that earlier it was said that the 10 million exemption applied individually to husband and wife, and he disclosed if he heard that correctly.
Yes. Yes. So
and then if that does apply, does it matter if the husband and wife file taxes jointly or single?
It doesn't matter. So if you got a startup company and husband invests $1 million, and wife invests $1 million, then they each will have their own $10 million limitation, even if they file jointly. Now, there is one quirk to that rule. If there is a sale, and regardless of who's selling, husband or wife, that generates a gain, then that gain is attributable equally between the husband and wife. So if husband and wife both invest $1 million, and then some period of time down the road after 5 years, where we meet the 5-year requirement, and husband sells some or a portion of his stock and realizes a gain, let's just say the gain is $2 million.
Sure.
Then $1 million of that gain is going to be attributable to the husband, and all $2 million can be excluded under 1202, but $1 million is going to be attributable to the husband and the $1 million is going to be attributable to the wife, such that when we now apply the $10 million limitation to the wife moving forward, she will be deemed to have already used $1 million of her $10 million limitation. So that is a quirk as it relates to how these rules apply to husband and wife investors.
Understood. And we had a follow-up question on that says that asks, so a liquidity event can trigger this exemption.
Yes, yeah, any sale or exchange of the stock, you know, that meets the requirements and has been held for the requisite 5-year holding period, that any sale or exchange of the stock that generates a gain, this exclusion is potentially applicable. Whether it's a sale, a particular liquidity event where somebody's coming in to buy the entire company, or if it's just a shareholder who is ready to get out and has found a buyer is ready to take out that individual shareholder, and again the shareholder agreements and corporate governance documents allow for the sale. Yeah.
Understood. And then we had another question, which was so let's say I'm an entrepreneur and I'm a part of 3 C Corps. Does that mean that I have a $10 million exemption in each C Corp, or
Yes.
do I, as the entrepreneur, have a consolidated 10 million across the spread?
No, this limitation applies on a individual by individual basis and a corporation by corporate basis. So in that hypothetical, that individual would have a $10 million limitation with respect to each of the 3 C corporations.
Understood. Any other questions from the chat? I figured it'd be okay to maybe go to 12:05 and then end it there. Well, in the meantime, I do want to remind everyone that's listening in today that this presentation is being recorded, and that everyone here will receive a link or a copy of all of this to everyone who registered, so that way you'll have this for your reference. I've received a couple of emails and pings already, Maurice, about how this is something that definitely resonates, obviously, with a lot of entrepreneurs, that there are member companies who struggle with some of these questions and this topic. And so just already the impact from y'all's talk and the responses that we're getting in the middle of this presentation is already positive. And so I do want to thank you guys for coming in and offering this insightful content and y'all's level of expertise. I think stuff like this just continues to prove the value that you guys bring to the community, and also why we have you as a resource partner, and why we're so thankful to have you as a resource partner. So
appreciate the opportunity.
Yes, sir.
Thank you, Austin.
Yeah, anytime. And team and folks in the audience, we do ask for you to complete a survey that's after this webinar. This is helpful for us to continue to provide more content and to see how we can continue to add value for you guys and your businesses. And please be on the lookout for upcoming SCRA webinars. These can be found on the SCRA website under the Get Support section. So, you know, we can do resource partner network content like the important topic we discussed today, as well as plenty of other CEO podcasts and interviews with member companies in our membership. So thank you guys very much. Appreciate it, Maurice and Mason with Nelson Mullins. And again, I've been your moderator, Austin Sagas with SCRA, and thank you all for attending.
All right, thank you, Austin.
Thanks.